last piece of credit cards specifically is going to be going over credit reports and scores. So credit, we know from the beginning, is going to be using money that is loaned to you in order to buy goods and services today with the promise that you're going to pay back that amount of money in the future. And so we have three pieces to the credit process. So we have the borrower. This is going to be the person who receives that money or that loan. That would be us. If I have a credit card or I have a loan, I am the borrower. We have a lender, and that's going to be usually the organization who is going to lend you that money or let you borrow that amount of money. So this could be the credit card company. This could be Discover or MasterCard. It could be a loan company. So there's financial institutions that you may be borrowing money for student loans or something. So they are the lender. And then we have our own credit history. And this is, again, we know that the credit history is going to be the history that I have with borrowing money from my past. So what are my other credit-related transactions, the types of credit that I've had in the past, and it'll just kind of identify how trustworthy I was when I was borrowing money. In order to have a credit report, the lender, so the company or the organization who is allowing you to borrow that amount of money, they are going to report your account history to a CRA. And a CRA just means that they are a credit report agency. And so each individual lender, if I have five credit cards, that means that I have 5 different lenders. They're each going to send a account or like a report of my borrowing history from them specifically to a singular CRA. So maybe this CRA, this credit reporting agency, is now receiving 5 documents on me from 5 different lenders. And they are going to keep that history. So they're going to combine all 5 of those documents into a single account history or a single credit history. So they are going to be the ones responsible for combining all of the different types of credit and different accounts of credit that I have into a single document. And this single document that they create is going to be the credit report. And it's, like I said, going to be a full explanation of my credit history or one single document that has each different piece of my credit history on it. So there's 3 agencies in the U.S. So we have Equifax, we have Experian, and we have TransUnion. Your credit report may look a little bit differently depending on which 3 of these agencies it's going to come on. So they may compile their information differently. They may weigh the importance of some information differently. And so my credit report may be different if I'm looking at a credit report from Equifax versus a credit report from TransUnion. And again, just like the credit history, if I don't have any credit, if I've never had a loan or I've never had a credit card, then I don't have a credit report because I don't have any credit history. So I have to have opened a type of loan or a type of credit, a line of credit, in order to have a credit history to therefore have a credit report. We are going to skip through this activity. Some information that we put onto a credit report is going to be starting off initially just our personal information. So things like your name, your address, maybe some contact information like an email or a phone number. A lot of times it might even have the last 5 digits of a social security number or some just identifiable information on top of a credit report. We are going to have our account information. So what types of credit do I have? So what is all compiled in this credit report? a public record information, and then inquiry information. Inquiry information just means how often am I inquiring, or how often am I looking into opening a new credit card? Have I tried to open or applied to open a new credit card or get a new type of loan? If I'm doing that too often, that looks bad on me. And again, that personal information is going to be provided to lenders when I apply for a credit card. And because I provided that information to them, they are then going to transfer that over to this CRA, and then they will put it on my credit report. So like I said, my name, address, phone number, potentially part of a social security number. They're also going to include my birth date and possibly some employment history if I disclosed that to the lender. Some lenders I don't have to, some lenders I do. So if they have employment history about me, they're going to also transfer that information over as well. And so we see at the very top of the credit report, we have all that information identified. Credit account information, like I said, this is going to be specific to each type of credit that I have. So if I have credit cards, if I have student loans, if I have a car loan, they're all going to be identified here. They're going to tell me what type, it's going to identify what type of credit it is. So what type of loan or what type of credit line it is. It's going to tell the amount that I owe on it. So how much did I get this loan for? If I got a $10,000 loan for a car, they're going to identify that. Or if I have a $1,000 credit limit on my credit card, it will identify that as well. It'll tell me the account balance, so how much do I still owe on it, and my payment information. So am I consistently making payments on time? Have I ever been late on a payment? Have I ever requested to defer my payment? Things like that. We again know the difference between closed-end and open-end credit, or installment and revolving. So this is just kind of a new way to describe these. They're the same definitions, just in different words, with some new examples. And again, so if we were looking at a credit report, I would see this would just be one type of credit that I have. It tells me the company name, their address, and then the details about my account history with this loan or with this lender. So it tells me when I opened it, if I currently still have it, the type of credit, how much I owe, and then some of those credit details. Again, if we're thinking about the loan amount or the credit limit, that's going to change whether it is closed end or open end. Closed end is going to be a loan amount. Open end is going to be a credit limit, because open end are credit cards. We see that right there on our credit report, or on this piece of our credit report. It tells us the date that we opened it, and our account balance. And then also tells us our payment information. So we can see that this is past due. So if it was not past due, if they had made their payment on time, this would be gone. That would no longer be there. And I would have a recent payment in this section. Public records, they're going to pull from your local community, your state government, and the federal government to get some of these public records if you have any of these public records that need to be collected on. So they're going to go through a collection agency. This is just going to be a business that is hired by a lender in order to kind of track you down and get that money that you have not paid back to your lender. So if you have missed any payments and they had to send a collection agency back to you, that is going to be a piece of public information that will be identified on your credit report. Bankruptcy, if you have not been able to pay some debts and you have declared bankruptcy with the government, that will be identified on your credit report. A tax lien means that you did not pay your taxes in full at the end of the year. So if we get our tax liability what we owe at the end of the year when we file our taxes in April, we get our amount back. We realize that we did not pay enough last year, so now I owe $200. If I do not pay that $200, I am in a tax lien situation, and that is going to be identified on my credit report. And then lastly, if we have foreclosure, this is a situation that happens if you own a home. So if I have a home loan, I stopped making my bill, I stopped making my payments, I stopped paying that bill. Like I said, the lender or the bank is going to take possession of my home, and that means that I am in foreclosure. If the bank comes for my home and kicks me out, I am in foreclosure. So all 4 of these are types of public records that would be identified on your credit report. And we can see that that is going to be a completely new section. In this scenario, we see that she had traffic tickets. She did not pay them, so they were turned over to a collection agency. And so they came after this person in order to collect on that money that she did not pay for those traffic tickets. And then inquiry information. This is going to be requests for an individual's credit report. And so in order for this to happen, it can be a result of actions by the consumer, again, meaning that you are trying to open a new line of credit, you're trying to get a new loan, something like that. They're going to try and look at your credit report or your credit scores. If that happens too often, it doesn't look great on your part. Or it could just be some other type of permissible purpose. So it doesn't necessarily always have to be related to opening a new line of credit or getting a new loan. There are other reasons why somebody may look at your credit report. Possibly you're moving, you need to rent a new home. That's not a loan, that's not a line of credit, but they might still want to look at your credit report and see how reliable you are. So that is seen in a different way. That's seen as a different type of inquiry than if you simply were to look into a new line of credit. And like I said, so that's negative. If I'm seeking additional credit or different loan types, that's going to be seen in a negative light. So this is going to be reduced. If I'm shopping around, like we know we want to shop around if we are going to get a new loan or open a new credit card. So if I am looking around and there are 2 or 3 inquiries that are within a 2-week period, that means that I'm just shopping around. I'm not actually trying to open 2 or 3 different lines of credit. I'm just looking at my different options. And so that kind of reduces the negative impact this can have on your credit report. And then some inquiries that do not have any impact are going to be ones that are not initiated by you. So like I said, if you are going to try and rent an apartment and your landlord would like to look at your credit report, that's not necessarily initiated by you. It's not related to credit, so it's not going to have a negative or a positive impact on your credit report. And you are more than welcome to just check your own credit report. That does look like an inquiry, but that does not mean that it's going to negatively impact you, because you're allowed to see your own credit report with no harm to yourself. So there are a few types of companies who are going to report to one of those credit reporting agencies. So those are going to be depository institutions. We know from the last few units, a depository institution is a bank or a credit union. We have credit card companies. We have retail stores that might offer credit accounts. So you may have a family member who has a JCPenney card, a Macy's card, a Dillard's card, something like that. Those are lines of credit. Those are credit cards. They are just directly tied to a retail store. So they are still going to report to these credit reporting agencies. And then finance and mortgage companies. So anywhere else that you might get a type of loan is going to be reporting as well. And they're going to report all of the information that is both positive and negative. We saw that on that example credit report where public records were taken in and their credit card reported that they had not paid their bill yet. That is negative information, and they are going to report all of it. And then there are what we call data furnishers, and they are also going to report to credit reporting agencies. They do not have to be credit based, but they are going to still report to these CRAs if you owe them money that you have not paid. So if you are renting an apartment, your landlord is going to report to a CRA if you have not paid your rent for the last couple months. The same with your cell phone or your utilities like your electric, your water, your gas, your trash company. They're going to report to a CRA if you have not paid your bill. The same with medical providers. So if you go to the emergency room, they give you a bill, you don't pay your bill, they are still going to report that because that does impact your trustworthiness when it comes to credit. If you are not paying your current bills, you probably should not be offered a new line of credit to increase your bills later. Some information that is not going to be reported in a credit report, meaning that it is not reported to a CRA, is going to be any of that medical information. So the hospital may send in information about you if you didn't pay your emergency room bill, but they're not actually going to report any of the medical information. They're only going to report the amount of money that you owe them. They do not identify ethnicity, gender, religion, country of origin, anything like that. They're not going to report on any accounts that you have that are not credit-based. They cannot identify anything about a criminal background, a criminal history, or your buying habits. So a credit card company may tell a CRA how much money you owe them, but they are not telling them what you spent that money on. Obviously, if you have a Discover card and they see that you go to the movies 3 times a week, Discover knows that you're spending that money at the movie theater, but they are not going to tell a CRA where you spent that money. And again, we've talked about this for the last few units. We know that our present self is always going to impact our future self. So we want to make sure our accounts are always in good standing, meaning that we are paying our bills on time. We are paying at least that minimum balance, if not more than our minimum balance, to keep those accounts in good standing. That information is always going to be impacted on our credit report. It does vary on how long things last on our credit report. So if we go around counterclockwise on our circle, our inquiries, so how many inquiries we have about our credit report, those will stay current for 2 years. Any of that public record information, so bankruptcy, tax liens, collections agencies, those will be available on our credit report for 7 to 10 years. If we have any late or missed payments, that will be viewable on our credit report for 7 years. And then if we ever closed an account, maybe we got rid of a credit card, but we were still in good standing with that credit card, that is going to be present on our credit report for 10 years. And then we also have what we call a credit score. So a credit score is going to be a number that is created for us, and it's going to be a really quick way to evaluate the risk that we present, and our trustworthiness that comes along with borrowing money. So it's going to reflect our entire credit report in a single number. There's a mathematical equation that they use in order to create this credit score. Different pieces of the credit report have a different weight or different impact on our credit score. And this number does change. So it is going to be current at a specific point in time. This number could change month to month based on new transactions, based on new payments, things like that. And it's basically going to be seen as your grade for financial responsibility or financial trustworthiness. Alrighty. The most common scoring systems that are produced by our CRAs are going to be FICO. FICO ranges from 300 to 850. FICO is the most common scoring system. That's the one you're going to be more familiar with throughout your life. And then we also have Vantage Score. And these are higher credit scores. These range from 501 to 990. The higher your credit score, the more trustworthy you are. So the higher your credit score, the more likelihood that you will repay the loan or the type of credit that you have borrowed. And again, the type of this, how the score is calculated is going to depend on each of these different scoring systems, as well as the personal information that is shared with the CRA. Credit score does have a huge impact on your borrowing availability. So we're going to look at 3 different credit scores and see how that impacts. Alrighty, so if I got a $15,000 loan, it is going to be for 3 years. That is pretty normal for an auto loan. And we can see how the interest rate is going to significantly change based on our credit score. The higher my credit score, the more trustworthy I am. We know that now. And so the lower my interest rate is going to be because there's less risk for the lender. So if I'm in the 700s, I'm going to have probably around that 6%. With that interest, I'm going to end up paying $16,452 on a $15,000 loan. Whereas if I had a lower credit score, I'm below 600, I will have a almost 14.5% interest rate. So I will be paying just over $18,500 overall. So I'm spending $3,576 more because I don't have as good of a credit score. It's not just going to affect your credit interest rates, because they do look at your credit history for a lot of different pieces of your life. So whenever you're going to get insurance, whether that be home insurance, auto insurance, they're going to look at your credit history a lot of the times. And again, that's going to change what your rates are, how much you actually have to pay. The same goes for housing. You may be denied to move into an apartment based on your credit history. Some types of jobs may look at credit history, as well as public utility services. If there are multiple companies to get internet through, they could deny you internet because your credit score may not be high enough for them. So in order to create a positive credit history, we want to pay our bills on time and consistently. We want to maintain a reasonable amount of available credit. So that means that if I have a credit card with a credit limit of $1,000, I don't want to have $999 used all the time. The more available credit I have, the better my credit score will be. I don't want to be consistently applying for new types of credit. I want to do that rarely and only when I actually need to. Because again, every time I apply for credit, I am having a credit inquiry, and that affects negatively on my credit report. I want to have multiple types of credit. So I don't want to have 5 credit cards. I want to have maybe 1 or 2 credit cards, a student loan, a home loan, an auto loan. I'm diversifying the types of credit that I have because that looks better for my credit history. Again, kind of bouncing off that one. You don't want to have too many of one type of credit. And you want to check your credit report at least annually because that will tell you, what your credit score is. It'll tell you what lenders are seeing whenever you have a new credit inquiry. So the better your credit history, the higher your credit score is going to be. So a really good way to build credit, especially now that a lot of us are going to be graduating this year or next year, we want to do this in small lines of credit because that's going to make it a little bit easier for us to manage, especially if we're not working full time. Maybe we're going to school, so we aren't going to be able to afford to have a huge line of credit. So we could get small closed-end credit from a depository institution like a bank, where we set up automatic payments. Setting up automatic payments makes sure that I am paying on time and I'm paying at least that minimum amount. So I'm building a positive credit history. And again, we are doing a small loan. That way I am not spending too much money. I could get a credit card with a cosigner. So you could have your parents cosign on a credit card with you, meaning that they are also responsible for paying back this debt if you cannot do it. That's a really good way to build some credit if your parents are comfortable doing that. You could open what we call a secured credit card. And so a secured credit card is kind of halfway between a debit card and a credit card. So you're going to have a security deposit on it. You'll have to have some cash up front. And that cash up front, make sure that the credit card company will get paid if you stop making your monthly payments. But you're still going to be building actual credit. So this is a really good way if you have some money right now, but you can't get a regular credit card because you don't have a cosigner. You could maybe open a secured credit card and start building that credit in a more manageable way. Or you could potentially become an authorized user on somebody else's credit card. So if a parent or a guardian already has a credit card and they maybe want to get an extension of that, another card with your name on it that is still connected to that same account, you will then be able to build some credit based on the credit that your parent or your guardian already has established. A lot of people think that credit can be really negative. And it can be if you're not using it appropriately. But in some instances, having no credit history can be just as detrimental as having a bad credit history. So we do want to try and build our credit if we can, but we just want to make sure that we're doing it in a way that is realistic for us. That way we are only building a positive credit history. So we can request a credit report. We know that we want to be checking our credit report annually. And we can do this for free once a year from one of those 3 credit reporting agencies. So to getting our one free credit report, we have to request it even if we have not used credit this year. And if we are denied credit, so if we try to get a new line of credit and we are denied credit, we can request another free copy within 60 days. So every year we're going to get a free view of our credit report. And we have another opportunity to freely view our credit report if we applied for credit and we were denied. That's just because then we can go in and we can see what the credit lender actually saw that made them deny us for that line of credit or that loan. When we want to access our credit card, this must be ordered separately. This is not going to be on that same request when you view your credit report. Your credit report and your credit score are different. Reviewing your credit score sometimes costs a fee. Depending on the different types of credit that you have, you may be able to see your credit score for free through that lender. But if that is not an option, the 3 CRAs are going to be the primary source and the most reliable source for checking your credit score. And again, just like your credit report is going to change based on which CRA you are working with, so will your credit score. If you are looking at your credit score or your credit report and you think that something is incorrect, you're going to want to contact that CRA directly. You're going to provide them with whatever information you think is incorrect. They have 30 days to investigate this claim to identify if this is correct or if that information is incorrect. And if they actually find that error, then they have to communicate that with the other 2 CRAs. And then we have another kind of CRA term, and this is going to be a credit repair agency. And this is going to be an agency that they advertise themselves as a way to fix a negative credit report. And so whenever we are thinking about these credit repair agencies, according to the Better Business Bureau and the Federal Trade Commission, as a regular consumer, you can do just as good of a job trying to repair your own credit report as these credit repair agencies. Going through a credit repair agency, you're going to have to pay a fee in order for them to help fix your credit report. But there are things that you can do to help repair your credit history without paying this fee to these agencies. And this is because there really is no immediate fix for negative credit. It's all based on your past decisions and your credit history. So their advertising of an immediate fix is just not really accurate. So do your best not to get caught up with these credit repair agencies. It may seem like a good idea at first because they give you the impression that they can quickly change your credit report, and that is not accurate. Alrighty, so just wrapping up, we know that we can build a positive credit history, and that looking at our credit history is going to help us identify how risky we are to lend money to. Our credit history is going to be a huge factor in our credit score, and the credit score is going to be that snapshot, that grade that tells us if we are a good borrower. And our credit score helps us to continue to develop a positive credit history in order to manage our money responsibly.